Usually when we talk about a financial market diagnosis, there is this expectation of precision.
Right, like it's a science.
Yeah, exactly. It's supposed to feel like engineering. You look at the data, the inflation report shows a specific number, and the analyst just points and says, there it is, that's the trajectory.
I mean, it's comforting to think of it as binary, up or down,
Yeah.
bull or bear.
It is clean. But then you step into the market landscape we are looking at today, April 24th, 2026, and suddenly that diagnostic machine it's completely broken.
Well, shattered.
Yeah.
Hmm.
Looking through the stack of research and articles you sent over for us to analyze today, the financial landscape is incredibly murky. So welcome to your custom deep dive. Today, our mission is to make sense of a heavily conflicted market.
Because there's a lot conflicting right now.
A ton. We are navigating a massive collision, geopolitical shockwaves, a stubbornly cautious Federal Reserve, and, well, a huge week ahead for mega-cap tech earnings.
It really is the definition of diagnostic muddy waters.
Wow.
I mean, we have economic indicators flashing bright green in one sector and alarm bell red in another, and sometimes within the exact same economic report.
Which is wild.
Right. To understand what is actually happening with your portfolio, it requires us to step back and look at the underlying mechanics of how these forces interact.
Okay, let's unpack this because we have to start with the broadest lens, which is the macro picture. The overarching shadow dictating market volatility right now is geopolitics.
Absolutely.
Specifically, the U.S.-Iran conflict. The briefing notes you provided show that a ceasefire has been agreed upon, which, sounds like profound relief, but extreme uncertainty remains.
Yeah, the market doesn't just instantly relax.
Exactly. The conflict has heavily impacted the U.S. economy, consumer sentiment has hit a record low, and inflation fears are surging. So to make sense of the conflicting data in this environment, I keep visualizing the economy right now like a truck pulling a massive load up a hill.
Okay, I like that.
Like, the ceasefire means the driver has finally stopped aggressively slamming on the brakes. The immediate escalating friction has stopped. But because of the residual energy shock and, well, shattered consumer confidence, we are still dragging a heavy, heavy trailer up a very steep incline.
That is a highly accurate way to visualize the mechanics of a post-shock economy, because the data we're seeing is genuinely divergent. What's fascinating here is the severe split between consumer reality and wholesale reality.
Right. They look like two totally different economies.
Completely. The March consumer prices rose 3.3%. That is a highly noticeable jump, and it was driven almost entirely by the spike in energy prices due to the conflict.
Which everyone feels at the pump.
Exactly. But if you look at wholesale prices, what businesses actually pay for goods and raw materials, they only rose 0.5% in March.
Wow.
Yeah, that is significantly less than anyone expected.
I want to break down the how on that. How does the everyday consumer take an immediate painful hit to their wallet while the wholesale side of the exact same economy seemingly shrugs it off?
It's a great question.
Doesn't the pain eventually just flow upward?
Well, it comes down to the speed of impact and the nature of the contracts. Energy is an immediate, highly volatile cost. When geopolitical conflict threatens global oil supplies, the price at the pump reacts almost instantly.
Right.
Consumers buy gas every week at the spot price, so that hits the consumer price index directly and aggressively. However, wholesale prices represent a broader basket of goods, many of which operate on long-term contracts.
So if I run a massive bakery, I'm not buying flour at today's panic price. I locked in my flour prices, 6 months ago?
Precisely. Bulk purchasing, hedging, and long-term supply agreements act as a massive buffer against sudden geopolitical shocks. The wholesale market had a shield that the everyday consumer just did not.
Makes sense.
Furthermore, the underlying economic engine wasn't actually overheating before the conflict. Just before the U.S. headed into the war, a key Federal Reserve gauge showed inflation holding incredibly steady at an annualized 3%.
Oh, wait. So the structural foundation of the economy was actually stabilizing before all this?
Yes.
So the 3.3% spike was purely situational?
Yes. And just to give this some international context, the global economy isn't uniformly stalled out. The UK economy actually grew 0.5% in February, which beat all expectations.
That's a solid number.
It really is. So globally, there are pockets of genuine economic resilience. The issue is that the U.S. consumer is currently bearing the localized, psychological, and financial brunt of the war's specific energy shock.
Hence the record low sentiment despite the actual ceasefire.
Right.
Which means the consumer feels terrible, But the underlying wholesale data isn't actually screaming crisis. So if the consumer is dragging this heavy trailer, Wall Street naturally assumes the referees of the economy, the Federal Reserve, are going to send a tow truck.
They always want a tow truck.
They really do. Meaning, they're going to cut interest rates to provide relief. And looking at your notes, some market analysts are still out there stubbornly predicting a rate cut this year.
Yeah, they're holding on to that hope.
Ooh. But the actual Fed officials are aggressively pushing back on that narrative.
They are, and they are doing it in a very coordinated, public way across different regional districts. They are trying to talk the market out of its rate cut optimism.
Yeah, we've got Fed Governor Waller explicitly citing the Iran war and labor market risks as the reason to keep rates on hold. Then you have New York Fed President Williams taking it a step further, warning that the war is going to slow growth while simultaneously aggravating inflation.
Which is the classic stagflation fear right there.
Exactly. And Cleveland Fed President Hammack is out there flatly stating he expects rates to stay on hold for a good while.
A very clear message.
Very clear. And on top of all this institutional caution, we have a massive political wild card. Former President Trump has explicitly threatened to fire Fed Chair Powell if he doesn't leave office voluntarily.
Which introduces an entirely different, incredibly complex vector of risk into the financial system.
And just to be clear for the listener, we are simply looking at the facts reported in the sources here, not taking any political sides. We're just conveying the dynamic.
Yeah.
But I want to push back on how the market is digesting all of this.
Sure.
If Wall Street analysts are still predicting a rate cut this year, but all these regional Fed presidents are explicitly going to the microphones and saying they are hitting pause, why is there such a massive disconnect?
It's puzzling.
Right. Who is the market actually believing here? It feels like Wall Street thinks the Fed is just bluffing.
If we connect this to the bigger picture, the disconnect comes from a fundamental difference in what each group is structurally designed to optimize for. Wall Street analysts are looking at that record low consumer sentiment.
Yeah.
They are looking at that tame 0.5% wholesale inflation number, and they're optimizing for liquidity. They assume the Fed will have to cut rates to prevent a consumer-led recession.
Ah, I can see.
They are betting that the political and economic pain of a slowing economy will force the Fed's hand to provide that tow truck you mentioned.
But the Fed presidents aren't optimizing for Wall Street's liquidity. They are bound by their dual mandate, price stability, and maximum employment.
Exactly. They look at the 3.3% consumer inflation spike driven by the Iran conflict and realize that cutting rates right now, making money cheaper to borrow, could pour absolute gasoline on the inflationary fire.
Wow. Yeah.
And when you add in the objective political pressure, the threats regarding Chair Powell's tenure, you have to understand the mechanism of central bank independence.
Right, because why does the market actually care who the chair is as long as the math is the math?
Because markets price and trust.
Trust.
Yes, the global financial system trusts the U.S. dollar because they believe the Federal Reserve makes decisions based on economic data, not election cycles. If investors believe a central bank could become a political tool, meaning it might cut rates just to boost the economy before an election, regardless of inflation, foreign investors get incredibly nervous.
Oh, that makes total sense.
They fear currency devaluation. It creates a perfect storm of institutional uncertainty. Investors are left guessing not just about the economic data, but about the future independence of the central bank itself.
It's like trying to play a high-stakes game of chess, but someone keeps aggressively shaking the table.
That's a great way to put it.
So if the macroeconomy is a stagflationary trap right now, and the Fed is paralyzed by inflation and political pressure, institutional capital still has to go somewhere. It has to seek shelter.
Always.
And looking at the data stack you provided, it's fleeing directly into the mega-cap tech sector. Here's where it gets really interesting. Technology seems to be playing by entirely different rules, acting completely immune to this macro drag.
The tech sector has effectively built its own microclimate. The broader economic weather just isn't penetrating their atmosphere in the same way.
Let's look at the mechanisms behind that, starting with Palantir Technologies, PLTR. They are a top gainer today alongside Vickr and Tesla. But zooming out, Palantir has surged an astounding 1,600% over 3 years.
It's just massive.
It is. And looking at the underlying research, this isn't just speculative, crypto-style hype. It's being driven by actual measurable AI adoption and commercial expansion.
The distinction between hype and commercial expansion is critical here. Palantir isn't surging because they built a fun consumer chatbot.
Right.
They surged 1,600% because they're integrating artificial intelligence into core logistics, military targeting, and massive enterprise data
The
systems.
boring but lucrative stuff.
Exactly. They are taking fragmented, messy corporate data, making sense of it, and allowing AI to make operational decisions that save companies hundreds of millions of dollars. The market is rewarding that tangible utility.
And that software utility requires a massive physical footprint. This brings me to one of the most fascinating points in your research. We are seeing incredible shifts in physical infrastructure to support this. Data centers are deploying batteries in surprising new ways, and it's drawing massive investments from giants like Tesla and Apple. When I read that, I immediately thought of grid stability. Like, AI isn't just software, it's a massive energy vampire, right? Is that what is driving this hardware pivot?
That is exactly the mechanism at play. Training a large language model or running advanced AI computations isn't like running a traditional website server.
Yeah.
It requires massive, energy-dense server racks that draw an incredible sustained wattage. A regular municipal power grid is designed for the predictable, fluctuating use of residential neighborhoods and traditional offices.
Right, everyone turns their lights on at 6 p.m.
Exactly.
Yeah.
It is not designed for the constant peak load drain of an AI data center. Without massive industrial battery farms to act as shock absorbers, these data centers would threaten to destabilize local electrical grids with rolling blackouts.
That's terrifying.
Yeah.
So companies like Tesla and Apple aren't just investing in batteries because it's good PR. They're doing it because large-scale battery storage is now a required baseline infrastructure for the AI revolution to even exist.
Precisely. They're managing the energy load. AI is forcing legacy tech giants to aggressively adapt not just their software, but their energy strategies and their hardware.
And speaking of legacy giants adapting, we have to talk about the seismic leadership shift happening at Apple. John Ternus is taking over as CEO from Tim Cook.
A huge moment.
The market expects him to refocus the company entirely on product innovation after years of criticism over lackluster, iterative launches.
A leadership change at a company the size of Apple is a profound signal to the broader market about where the future of the economy is heading.
Yeah, when I look at this transition, I think of a championship sports team deciding to change its head coach right before the playoffs.
Interesting.
They aren't doing it because they are losing games, you know? Apple is incredibly profitable. They are doing it because they realize their old playbook won't win the next era. Tim Cook was a master of supply chain efficiency and legacy maintenance. He optimized what they already had.
He definitely did.
But John Ternus feels like an offensive coordinator coming in to run a completely new, ground-up innovation scheme to compete in this AI-driven hardware landscape.
That analogy holds up perfectly.
Right.
The through line connecting Palantir's massive commercial AI surge, the data center battery grid investments, and Apple's leadership pivot is the sheer physical and capital reality of the AI transition.
Yeah.
The software demand is proven. Now, the entire tech ecosystem is racing at an unprecedented speed to build the physical foundation and leadership structures required to support it.
And the market is clearly aggressively rewarding this specific focus. One of the reports you shared breaks down ETF performance, specifically noting that the FDVV ETF has actually outperformed the more traditional HDV ETF over a 5-year span.
Yes, that was a telling detail.
To briefly unpack the mechanics there for the listener, HDV is a traditional high dividend fund, usually packed with safe, boring utilities and consumer staples. But FDVV, while also seeking dividends, heavily tilts its weighting toward technology and financial sectors.
Right.
The fact that the tech-heavy dividend fund crushed the traditional safe haven fund shows that capital is flowing relentlessly toward this tech-driven growth, even amidst broader macro feels.
It is a clear flight to quality, but quality has been redefined. Capital seeks out growth, and right now, tech is the undeniable structural epicenter of that growth narrative.
But you know, a narrative is only good until it hits reality, and the ultimate reality check happens next week.
Oh, absolutely.
We are looking at an absolute gauntlet of earnings from the heavyweights: Microsoft, Meta, Alphabet, Amazon, and Apple. Today, Apple, Microsoft, and Amazon are already the most active stocks in the market as people position their portfolios.
Everyone is getting ready.
The research makes it clear that this is a critical test for the broader market, which is relying heavily on these mega-cap tech stocks to just stay afloat while the rest of the economy deals with the Iran conflict and the Fed's holding pattern.
It is the ultimate stress test for the entire financial system. Analysts are expecting revenue and earnings beats across the board from these giants.
So what does this all mean? Like, For the stock prices, I have to raise a skeptical point here. If Wall Street already universally expects all these tech giants to beat their past earnings, isn't the bar set impossibly high?
It is very high.
Right. If Palantir's 100% surges and the massive battery infrastructure hype are already baked into the current stock prices, how can these companies possibly impress investors next week? What mechanism actually drives the stock up at this point?
This raises an important question, and it is the exact puzzle keeping institutional investors awake right now. The actual backward-looking earnings numbers, what they made over the last 3 months, almost don't matter as much as they used to.
Really?
Yeah, Wall Street assumes they crushed last quarter. The real driver of post-earnings stock movements next week will be their forward guidance.
The promises they make for the next year.
Exactly. But specifically regarding capital expenditures versus operating revenue, the market knows these companies are spending billions on AI infrastructure, those massive data center batteries we just talked about.
Yeah, the hardware.
That is capital expenditure. What the market is desperately looking for next week is proof that this massive spend is translating into sustainable, measurable revenue. They want to see subscription growth for AI copilots. They want to see cloud computing margins expanding.
I need to prove AI is a profitable utility, not just a black hole of infrastructure costs.
Right. If the forward guidance on AI monetization is even slightly vague, or if they admit that profitability is still years away, that impossibly high bar you mentioned becomes a cliff. The market will punish them for spending billions without a clear path to return on investment.
Wow. And we are already seeing some counterintuitive market reactions today that show just how incredibly forward-looking and, well, unsentimental investors are being.
Oh, for sure.
Looking at the market movers, today's top losers are Iran-related stocks and energy stocks.
Which initially seems completely contradictory, considering we just discussed how energy spikes drove consumer inflation up to 3.3%. You would assume energy companies would be swimming in cash right now.
You would think they'd be flying high. But the mechanism at play here is the risk premium. When bullets start flying and supply chains are threatened, speculative money rushes into energy stocks, driving the price up based on the fear of future shortages.
Right.
But because a ceasefire has been agreed upon, the immediate panic is over. The market is instantly pricing out that geopolitical risk premium. The speculative money is retreating, leaving those energy stocks as the day's top losers, even though the price of gas is still physically high at the pump today.
It proves the market is always living 3 steps in the future.
It really does.
It perfectly illustrates the dichotomy. We were watching a market aggressively trying to price in a stabilization of the old physical economy, while simultaneously demanding absolute perfection and rapid monetization from the new tech economy.
It is an incredible high-wire balancing act. So to bring this all together for you, the listener, we have covered a tremendous amount of ground in the research stack you provided today.
A lot of moving parts.
We started with the macroeconomic gridlock, an everyday consumer economy dealing with the painful hangover of an energy shock from the Iran conflict, despite a formal ceasefire. We looked at a Federal Reserve paralyzed by this conflicting data, facing a brutal tug-of-war between fighting inflation and protecting growth, all while navigating intense political pressure and threats to its institutional independence.
And we contrasted all of that macro friction with a technology sector that seems to be operating in its own frictionless reality.
Exactly. A tech sector banking its entire future and thousands of billions of dollars on massive AI infrastructure, industrial battery deployments, and fresh, aggressive leadership transitions. The contrast between the macro struggles of the everyday economy and the micro triumphs of the tech sector is the defining story of this specific moment in 2026.
The divergence is real, and it is the exact space where the future of the broader market will be decided over the coming earnings season.
It really is. And before we wrap up this deep dive, I want to leave you with a final thought to ponder something that builds on everything we have unpacked today.
Okay, let's hear it.
If these mega-cap tech giants successfully build out their own massive AI-driven ecosystems, if they prove their billions in battery and data center investments are generating massive profits, while the broader traditional economy remains squeezed by inflation, cautious central banks, and geopolitical gridlock, are we accelerating toward a truly two-tiered economy?
Ooh, that's heavy.
Right. A future where the technology sector and its institutional beneficiaries completely detach from the everyday financial reality of the average consumer. It's a massive question. And how next week's tech earnings play out might just give us the first real clue as to whether that detachment is already permanent.
It's the ultimate structural question for the next decade of investing.
Absolutely. Thank you for bringing these fantastic, complex sources to the table today. The diagnostic machine might be completely murky, and we might be driving up a hill with a heavy trailer, but unpacking the underlying mechanics with you makes the road ahead a lot clearer. Keep exploring, stay curious, and we'll catch you on the next deep dive.